Hi, folks. I've been wanting to make this quick presentation on why we should be looking at India for the long term. Obviously, there are a lot of reasons to it, and in the present situation, India has the advantage of becoming the manufacturing hub of the world, the next China, as we could say. We got all the ingredients for this great recipe. Also, this scenario of U.S. and China, India could be a potential hedge against this trade war. If you see, India is mainly a domestically driven economy, and with exports getting the thrust after getting this manufacturing advantage, we could be seeing India growing even faster. In the last uh, in the last year, 2019, India had a growth rate of 5%, which was five times that of US and double that of Australia. So there are lots of reasons. The basic reasons are obviously India being the fifth largest economy in the world. Obviously, economic growth has been steady, and in the next 10 years, it's gonna keep going at 7 to 8%. As you can see, India could be quadrupling its GDP in the next 20 years or max 25 years. India has a very diverse set of industries, and the economic development is happening from the core, which gives again a major advantage. And as you all know, India is one of the youngest countries in the world, average age of 25, and the workforce which would dominate the global economy. So that's a major advantage as well. Adding to this is a lot of steps taken by the government to encourage private and foreign investments. As you know, it's a domestic economy, so India's wealthiest consumers will increase by 40 million in the next 10 years. Well, every sector with India's consumer market is booming, and we are less vulnerable to external pressures. The financial sector is very, very solid. RBI has been very strict with its policies, and India has been resilient in the past whenever a crisis has emerged, a financial crisis. And yes, talking about the Bombay Stock Exchange, the second oldest in the world, um, has been well governed as well. So that gives another major tick to why we should be looking at the stock markets in India. Folks, India makes up around 1.5% of the global stock market. This is as per MSCI All Country World Index. It's a small percentage, but it's a growing figure. As per Jeffrey Gunluck of Double Line Capital, who is very expressive about India and why he loves India as an investment opportunity, he says, invest in India and don't look at your statement for 25 years. Jeffrey has been very expressive that he feels that though Indian markets are volatile, but in the long term, he feels wealth creation will definitely happen. From Ray Dalio, the hedge company Bridgewater Associates, he gave again a very great statement saying, "I would say I am more optimistic about India than any other country." Again, that's a big statement. No wonder a lot of investment management companies like Nomura and CLSA, Morgan Stanley's, and all have been aggressively putting money in India. And for the long term, you can see pension funds in the US, Europe, and Japan. They have also been aggressively parking their funds in India. So that's another major tick. The foreign institutional investors have been pumping a lot of money in India in the last decade, over a decade now. There are lots of reasons for it. Well, as of now, if you look at India's scenario in 2020, where Indian market is trading at 60% market cap to GDP, which definitely is not overpriced. India has $500 billion of forex reserve. The oil prices are down. You know, India has a major trade surplus, and in fact, recently I was reading this article which says that RBI is now fighting to support the dollar and not the rupee. So a lot of positives going for India, and no wonder FIIs have been pumping money throughout the last 12 years, and maybe this figure might jump up by another 5 7%. You never know. So yes, another big tick. That's the IMF World Economic Outlook for India. This was in 2019, which was forecasting a 30% jump in the next 5 years, India's per capita income. We are factoring the COVID crisis, and we can trim it down to 20 to 22% of growth. but that's also pretty commendable. And uh, by 2024 or 2025, we're looking at India's per capita GDP to cross 3,200 US dollars, which is definitely a good leap. So passively taking exposure to the Indian market can be done through these exchange traded funds. There are around 15 of them that's in the market. Depending on your own choice and your own preference for what kind of exposure you want and how aggressive you want to go on India. Accordingly, you can choose any of these. For me, I have chosen four of them, and I am elaborating on these four. And I like all of these four. They fit my criteria of investing, and maybe it could be helpful to you as well. The first one is undoubtedly the largest one, INDA from iShares. It has 85% of Indian stock market by market cap. Total number of stocks 87. It has a decent, it's an average expense ratio 0.69. So usually expense ratios are between zero point 0.3 to 1.1, and this is somewhere in between. So an average expense ratio, top five holdings and top sectors are in front of you, and it replicates the MSCI India index. The second one we are looking at is INDY. So this is the replica of India's Nifty 50, large cap Indian equities. It's a plain vanilla take on Indian large caps. S&P CNX Nifty index. That's what it's tracking. Management costs are slightly higher at 0.93, and this is the second largest from by iShares on Indian equity markets. The previous ones were listed in the American Stock Exchange, the US Stock Exchange. Now we're looking at the Aussie Exchange, the ASX listed ETFs. The first one we're looking at is ETFS Reliance India Nifty 50, and as the name suggests, it replicates India's Nifty 50 index. Started just in June 2019, so it's a new fund. Not a very big asset base. It's only 11.4 million Aussie dollars. Management costs are slightly on the higher side, which needs to be looked at, and it's an aggressive Nifty replica ETF. This is the other India-focused Australian listed ETF, which is IIND. This is by Beta Shares. I like this fund. It's a very concentrated fund. Again, launched just last year, and it's sort of a more of a defensive fund because it's got less exposure to financials and energy. As you see the sectors, it's more into consumer staples and IT, which are more defensive. And again, a small fund, and management costs are at zero point 0.8, which is an average cost. So, folks, we looked at the four ETFs. Two are US exchange listed and two are ASX listed. This review over here was just to give you information on what these ETFs offer. It's not a recommendation, it's just my analysis on them, how big they are, how concentrated they are, and you need to look at their past performance and their tracking error, which can be researched online. Uh, but these four ETFs, I believe, are good enough to have a look at. They also have been trading for a while, at least the first two ETFs of the US listed ones, the INDA and INDY. As you know, INDA is more diversified. So the most diversified and the largest is INDA, and then INDY is the Nifty one. For the ASX listed one, I personally like IIND, which is a concentrated ETF because it's slightly defensive as well. And then if you just need to have a straight vanilla focus on India Nifty, then you can look at NDIA. Again, the presentation was just to give you a brief understanding of what options you have. You do your own due diligence, but one thing is for sure, time to get bullish on India is right now, and we could be looking at the best growth story for the next 5 years. We might be able to beat any other emerging market by a big margin, and returns would be really nice. I believe at least 15 to 18% annually in the next 5 years is sort of given if things go as per plan with the stable government and geopolitically, if there's no other major hiccup, we should be looking at an amazing growth story for the next 5 7 years. Thank you very much.